what Kashkari just said about the last time the Fed had a plan to normalize the balance sheet, it went pretty okay. He's talking about quantitative tightening. That will be the end of this, of all of it, of the bull market that we've had since 2009. If they actually do QT and follow through with it, in addition to their rate hiking cycle that's accelerated, with the tightening liquidity that's already in the system, the slowing global economy, and cost to push inflation actually being exacerbated because suppliers will pay higher rates on their debt. So they'll actually pass those costs on down the supply chain, eventually landing in consumers' hands, which they're already dealing with higher prices that are going to be sticky. This is kind of the perfect storm. I'm pretty sure the Fed realizes that they have very limited power to affect inflation, since their monetary policy is essentially, well, it has a large delayed effect, but it's also top down. And supply chain disruptions are a factor of having to normalize, having to expand capacity. And if you increase the cost of debt with a lot of these leveraged players, it's actually going to diminish capacity and increase costs. The other problem is that the demand destruction side of Fed policy has a large lag time. So we might actually, they might be making the same mistake they make quite often, which is to say they're too late, they go too far, and they end up creating the crisis that they then respond to later. So, Kashkari is the most dovish member of the Fed, and he's sitting there talking about quantitative tightening, which is the most hawkish thing you could possibly talk about. It's a little early to read into this. We'll see what the Fed minutes say when they come out. I think it's on Wednesday, but this is sort of the discussion that could lead a lot of bulls to Valhalla. I mean, there's a lot of leverage in this market. There's a lot of folks who have not managed risk, and as the funding costs go up, so does the risk premium. And I feel like there's a lot of discounting that could happen as a result. So I was, sanguine about accelerated tapering for some of the cyclical parts of the market, but boy, if this happens, this is game over. QT, if they actually do it, let's say in March or June or something like that, that could bring about a rather nasty correction. And if they don't stop before they drain the liquidity out of the system completely, it could bring about a prolific and long-lasting bear market that is reminiscent of 2008. And I'm not even trying to go off the deep end here. I'm just looking at this objectively and thinking, what could happen if the Fed actually does start to sell off the assets on their balance sheet? How that would invert the paradigm that has given risk a bid for the last 12 and a half years. With a brief interruption in 2018, that large decline we had in 2018 was driven by quantitative tightening, primarily. And it wasn't until the later 2019, when they stopped quantitative tightening, that the market was able to make new all-time highs again. They also put up some reverse repo facilities and added liquidity in other ways to the market to try to stop it from kind of collapsing in on itself. But it seems to me like if you have very dovish members of the Fed talking QT, that's a trial balloon that's being floated to see how the market reacts. Someone obviously had some idea of this going into the week. You see the reaction in the bond market. You see yield curve bear steepening. The longer end of the yield curve, bonds are getting sold off aggressively. And a lot of fixed incomes underwater, a lot of rate-sensitive high betas underwater, a lot of parts of the market that are more leveraged are getting hurt more because the anticipation of rising funding costs is creating nervousness among investors. And of course, traders are looking to hedge risk or even opportunistically bet against some of these companies that are going to be more impacted. So unfortunately, what we're seeing in the first couple days of January may actually be a sign for how the year is going to go with the violence that's happening underneath the surface. And quite frankly, it could begin to pull the indices down as well, if indeed this is a path that the Fed is content to take. So I think it behooves investors and traders to be cautious here. This is a developing situation. It is another trial balloon that could signal monetary policy shift into aggressive tightening. Accelerated taper, as long as they're still keeping the balance sheet, the liquidity is still there in the system sloshing through. So that wasn't as much of a big deal for parts of the market that are more cyclical and more reliant on cash flows, and they have, positive cash flows that are growing over time. Those parts of the market can do okay in the end of QE and even some degree of rate hiking. But once you start to talk about quantitative tightening, which also suggests that, the rate hiking cycle would be pretty aggressive as well, that's highly problematic. The U.S. government pays their debt, their interest on their debt, and it's usually averaged to the price of the 10-year. So with the rate moves that we've had just this week, let's just imagine for a moment that we get to 2% with $30 trillion of debt. That's $600 billion of deficit spend every year. The DoD budget last year was $740 billion. So let's go to 3% on the 10-year, which is something that a lot of people are calling for this year. That pushes the deficit spend on interest alone to $900 billion a year, which is getting to the point where it might force austerity. And remember, we're not even talking about how when the Fed buys debt, they actually pay the interest they earn back to the Treasury at the end of the year. So that's another discount that the Treasury gets on all the debt that the Fed holds. So, you talk about the end of QE, you talk about rates going up, you talk about QT, and all of the impacts that has on debt markets that bleed through to risk. That's exceedingly dangerous for a lot of risk assets, and I don't know that any could really come unscathed. The most interesting part about this is crypto still seems to sort of have a bid. If any of all this stuff is going to get smashed into dust because of what's happening with central bank policy and global liquidity tightening, it's going to be crypto. It's not really a hedge against inflation. It's not really a store of value. It's not really a currency. It's a very speculative asset class that relies on an abundance of liquidity in the system, negative real rates, making it more attractive as a long duration risk asset, and all that's coming out, especially, again, if they do QT. So, let's talk about 4% on a 10-year bond. If they do QT and rate hikes like they're talking about, that's possible. That's $1.2 trillion on $30 trillion of debt. $1.2 trillion deficit spend on $30 trillion of debt. That forces austerity. It also causes questions as to whether the government is going to be able to be fungible, whether they're going to push a lot of debt to the shorter end of bonds as they refinance, trying to get away from those higher rates, which creates different problems, right? That supply of debt to the shorter end of the yield curve could invert the yield curve, could create a lot of pressure for banks, could even lead us into a recession. So this is the first time in a little while that I'm looking at this stuff and saying, gee, I'm not so sure that 2022 is going to be such a good year for equities, because you've got Neil Kashkari, one of the most dovish members of the Fed, talking QT and saying that it went pretty well last time. And if you look at what actually happened, there was nothing that really went well about it, unless the goal was to deflate risk assets, increase yields, and create a lot of anxiety in markets, a lot of volatility. Maybe that's what they want. After all, the Fed can't trade stocks anymore, right? The members of the Fed have been told they're not allowed to trade stocks anymore. So maybe they sold the top and they just don't care. I don't know. But I think that these indications of potential policy pivots are things that are important to watch, because they're road signs and they're being put out there in the very start of 2022. And we already saw on the first day of trading, we saw a bear steepener across the yield curve. We saw a flood out of rate-sensitive stocks. We saw cyclicals getting bid up. We saw even defensives getting sold off a bit. And we're seeing that continuation today. So it's sort of like the fade the Omicron worry play. A lot of the reopening stuff, a lot of the cyclicals are getting bid. A lot of the work from home and growth in tech are getting faded. But the real story is rates. And what the Fed is broadcasting now only says that rates are set to go meaningfully higher, and there does come an inflection point where even the strongest parts of the market will get trounced by higher rates because now there is an alternative. Now, instead of just having to buy stocks, Tina, you get to a place where actually fixed income starts to look more attractive when you have real rates that are positive, when you have the ability to, feel that some of these instruments have been somewhat de-risked with the prices going down meaningfully. So, it's too early to tell where any of this goes, if it was just a trial balloon or not. But I think it's very important to keep an eye on the Fed, whether they continue to talk about QT, whether they talked about it more in their minutes, what kind of indications they have insofar as timing and velocity of quantitative tightening, because all of this is going to have a major impact, and not just on risk assets in the U.S., but across the world, because the wall of liquidity that came from the Fed and, the ECB and the BOJ have really been the primary driver of upward price revisions across multiple risk assets. I mean, this is not a stock market that is tied primarily to GDP growth or other kinds of econometrics. In fact, we had many occasions where we had weak economic data, and that gave cause to people bidding equities up because the thought was that the Fed would forestall any kind of tightening. So we had sort of the opposite impact. Not only do we not want a strong economy, we desire a weak economy because the primary driver of upward price revisions, liquidity, could become less constrained, maybe even more abundant. And that's something that we've seen on and off throughout the bull market since the great financial crisis. So to me, that is important. It's a distinction. It tells you how money managers are thinking. They're not looking at the economy and hoping for strong data. And a lot of the prints that we get of strong data, they cause some parts of the market to roll over pretty materially. So if it isn't the economy driving the market, it has to be liquidity. And this is something that I've talked about for quite a while, that liquidity is the primary driver of upward price revisions, that the economy does have a role to play, but it's a secondary role in the stock market that's existed pretty much since the mid to late 90s, but especially in the post-great financial crisis. And now we're in a situation where policymakers, they have to at least give the appearance of being concerned about inflation, because this is the first round of, higher than expected inflationary prints really since the late 70s, early 80s. And so you've got a lot of people in markets that aren't prepared for this. You've got a lot of people then policy making decisions that haven't seen anything like this. I'm not sure that the Fed is going to want to tell the world that they're kind of helpless to stop inflation. I think they want to broadcast from a position of strength, even if it erodes their credibility. But the fact is that, their monetary policy really only drives asset inflation, because the transmission mechanism for Federal Reserve policy is directly into financial markets. And it sort of maybe trickles down at times. But the way it trickles down is by increasing the price of assets, reducing funding costs, and driving demand that way. So not only is there a buffer, there's a latency to the impact into some of this policy insofar as how is it translated to the Main Street economy. But there's also a misunderstanding by legislators like Manchin, who have called on the Fed to stop because he's concerned their policies are what are driving inflation. What's driving inflation is really going to be the combination of the supply chain constraints and an abundance of fiscal policy that gave money to people that are going to spend it immediately. When the bottom 60% of consumers gets money, especially in an environment where costs are rising, they're going to spend that money. They may even hoard goods if they anticipate that those same goods are going to get more expensive in the future. And I say that because I think it's a distinction that is important to make, that monetary policy is more synthetic and fiscal policy is more tangible. That doesn't mean that monetary policy doesn't have tangible effects. It certainly does. Look at home prices. But at the other side of it, the primary impacts of monetary policy really are things like rate, the price of debt, the price of risk, the risk premium that we see in stocks, in crypto, in other parts of the market, higher risk debt. And I have a very, sort of odd inclination that because everything has become so politicized, we may end up pushing too far in the wrong direction because both parties are saying, oh, there's too much inflation. Oh, we really need to be concerned about that and do whatever we can. Well, I mean, the only thing that central banks can do to fight inflation when it's driven by exogenous factors. I mean, yes, there's a demand side to this, but I don't feel it's the primary driver. I think it's the secondary driver. It may be a close second, but if you destroy demand by raising funding costs and leveraged components of the supply chain have their debt funding costs increase the same way, they're going to have to pass those costs on. So is it really going to stop inflation? The demand destruction might tame it a bit, but the knock-on impacts of tightening liquidity could create a different kind of constraint. And again, if this was all demand-driven, it would be a lot easier. You raise rates, you destroy the demand, right? But it's just not that simple. There's a lot of areas where you can't create new supply by destroying demand. You simply reduce demand. And if the demand is not reduced commensurate to the supply constraint, then it only temporarily alleviates some degree of the inflation. So I'm a little concerned about where this all goes because I think that not only are policymakers trapped a little bit here, but the other side of the equation that's not getting talked about enough is the amount of global debt that keys off of U.S. 10-year rates. I mean, it's over $150 trillion worth of debt. So small variations in rate, especially if they happen with high velocity, cause ripple effects throughout the global credit market, throughout the global economy. And so if we talk about, accelerated tapering plus rate hikes plus especially quantitative tightening, and you talk about maybe the ECB and Bank of Japan begin to follow along as well, it strongly suggests that we're heading down the road towards a deflationary global credit crisis. And I think that's where this all goes inevitably. I think that secular deflation will overwhelm cyclical inflation. I think that secular deflation has been the name of the game ever since we've had this prolific debt supercycle, ever growing and necessitating lower and lower rates to accommodate it so that it doesn't implode violently and in doing so cause a global depression. But now we have a different situation because instead of the disinflationary decades we've had since the early 90s, we're in an era of inflation, whereas motives have changed, policy objectives have changed, and yet the fragility of the debt supercycle has only increased. Leverage on balance sheets of governments and some corporations, not all, some are doing better, and also in households, it's increasing, right? Now, the good news about some of these corporations that are in better health is that, their balance sheets are healthier and they have better cash flows. But what happens is in a credit crisis is there's knock-on economic impacts that affect every player. The weakest fail first and hardest, but everyone is impacted. So it's far too early to tell as to whether the sort of road to perdition is the one that we're traveling on now. But I do think it's disconcerting that we are balancing what I think is cyclical inflation that is driven in no small part by supply chain impacts, post-COVID impacts, COVID-era impacts that continue to linger. There's a labor component to all this as well, and that's inflationary in the sense that if you want to, smooth out the lack of labor in some parts of the supply chain, you either have to automate, which requires, capital expenditure, or you have to hire new people or both, and those costs have to go somewhere. They're going to be passed down the chain. So that's an issue as well, and that's not something that's easy to resolve. That takes time. Hiring people takes less time than automating jobs in some situations, but both of them do take time to invest and to see the impacts. And then meanwhile, as we got into 2022, a lot of shipping and freight costs, the contracts were negotiated at higher rates. So you see that supply chain driven cost push inflation continuing. And there's nothing the Fed can do about that other than destroy demand by facilitating higher funding costs, which in turn slows the economy. That's not constructive to dampening inflation, especially if we consider the inherent risks that we have for the enormous amount of global debt out there, some of which is increasingly showing signs of stress. The other side of this is we have the People's Bank of China beginning to become more dovish, trying to offset this global liquidity tightening by entering their own sort of QE program, injecting liquidity into the markets, and talking about how they will do whatever is necessary to keep their markets liquid and to try to sort of ring fence risk around some of their real estate sector. And, the Chinese real estate sector is kind of a big deal. It's the biggest sector in the entire world of any asset class. So it behooves us all as investors and traders to pay attention to what's happening with regards to Chinese real estate, what the People's Bank of China is doing. And recall back to February through May of 2021, it was when the global central bank wall of liquidity, the velocity of that liquidity began to abate, that we saw the more speculative components of the market roll over. SPACs, Chinese tech, small cap, mid cap growth, biotechs, all that kind of stuff really rolled over then. And it was the People's Bank of China that pulled back first because they were one of the central banks that really leaned in heavy at first. And when they did pull back, that was one of the areas where we saw the velocity of central bank liquidity drop off. And in no small part, because they are really the second biggest central bank in the world in many ways. So in no small part, when they make moves, it is worth paying attention to. So the real question is, how far does the Fed go and does the PBOC offset them and other central banks? And then the other question is, do we see a meaningful slowdown in economic growth in 2022 with the backdrop of tightening liquidity and sticky inflation? Although I think the velocity of inflation will probably drop because of base effects and because we've seen some of these things beginning to show some small signs of improvement. The prices that consumers are paying is not going to drop in most places because these companies, even if their source costs go down, now they're making a better profit margin. Why would they give that up unless they have to by virtue of competition? So that's another thing that's important to watch in econometrics, because if you look at retail sales or other kinds of consumption numbers, we have to factor for things are getting more expensive, and therefore even a higher number isn't necessarily beneficial if they're paying more to get the same. So it doesn't show increased consumption. And that's important for the GDP as well. Some of the GDP growth has been a component of rising prices more than increasing activity. You look at medical costs, student debt, things like that rise at 2 to 3 times the rate of inflation, for example. So there's a lot of pressure on people in the economy. You've got COVID hospitalizations leading to bankruptcies for a lot of people, and medical debt is the leading cause of bankruptcy in the U.S., so that's a factor that's set to accelerate. And most people, especially the bottom 60%, don't have more than $500 to $1,000 set aside for a medical emergency, and the average hospitalization costs somewhere between $50,000 and $200,000. So do the math. It's not looking good even with insurance, which passes on some of those costs and doesn't cover everything and fights tooth and nail to cover as little as possible because that's the business model, right? So there's a lot of confluent factors that are going on heading into this year. But most importantly is going to be watching these central banks, watching the economy, and sort of watching these econometrics and see what takes shape from there. So those are my thoughts. I hope it's helpful. I just wanted to kind of put this out there because I've been brainstorming a lot and watching these headlines and these moves in the markets, and I'm starting to get a little bit concerned about some of the things I'm seeing.